Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in financial documents. And today, folks, we're diving deep into the Hartford Series Fund's latest semi-annual report for June 30, 2025. And trust me, there are some fascinating numbers in here that tell us a lot about where these funds are putting their money, and more importantly, how much it's costing investors. Before we jump in, if you're looking to get smart about your investments and understand what's really going on behind the financial statements, make sure you hit that subscribe button and turn on notifications. We also have a rocking community over on Discord, so come join the conversation and level up your financial knowledge with us. Alright, so what exactly are we looking at here? This is a report filed with the SEC by registered management investment companies like this Hartford Series Fund. It's basically a look under the hood at their investments and how they're performing for shareholders over a specific period, in this case the first 6 months of 2025. Let's start by looking at the Hartford Balanced HLS Fund. For a hypothetical $10,000 investment, the costs for the last 6 months were $32, which comes out to $0 in NFIC3 AT portfolio holdings. Now for the juicy part, the composition of their holdings. A massive 65.5% is in common stocks, meaning they're betting big on companies. Then comes US government securities at 21%, which is pretty safe, pretty standard. Corporate bonds make up 10.4%, and then smaller chunks in MBS municipal bonds and foreign government obligations. Next up, the Hartford Capital Appreciation HS Fund. For that same $10,000 hypothetical investment, the costs were $34 or 0.67%. This fund is significantly larger with over $3.6 billion in net assets, but holds far fewer securities at just 1/6. Here the story shifts dramatically. The biggest slice, by far 29.5%, is in information technology. That's a big bet on tech right now. Next up, financials at 14%, then communication services and consumer discretionary, both around 11%. They're really leaning into growth sectors. Moving on to the Hartford Disciplined Equity HLS Fund. Costs here were $30 for that 1,000 investment. That's 0.59%. This fund has almost 69 securities. That's a concentrated bet. Once again, information technology leads the pack at 31%. Financials are second at 13.5%, followed by communication services and consumer discretionary. They have a similar sector focus to the Capital Appreciation Fund, but with even fewer holdings, indicating a higher conviction in their top picks. It's interesting to see this concentration given the fund aims for discipline. Now let's check out the Hartford Dividend and Growth HLS Fund. Costs here were $34 or 0.66%. This fund is also quite large with over $3.2 billion in net assets and 68 holdings. The sector breakdown here is quite different. Financials take the top spot at 19.5%, followed by information technology at 18.8%. Then we see healthcare and industrials around 13%. This fund seems to be more balanced than the previous two, focusing on dividend-paying companies and established growth stories in more defensive sectors. Let's switch gears to the Hartford Healthcare HLS Fund. Costs were $45 on that 1,000 investment. That's 0.94%. This fund is much smaller with about $104 million in net assets and 80 holdings. Some pharmaceuticals. 28.8% as you'd expect. Healthcare is all the way up in focus. Pharmaceuticals lead at 28.8%, followed by biotechnology at 28%, then providers, services and equipment all in the mid to high teens. This is a clear play on the healthcare sector from top to bottom. Scroll. Hartford International Opportunities HLS functions. Next we have the Hartford International Opportunities HLS fund. Costs were $41 or 0.76%. This fund invests globally with $806 million free holding, with $86 million in net assets and 83 holdings. Geographically, Germany leads at 14.7%, followed by Japan at 13.7%, and the United Kingdom at 11.9%. The United States makes up less than 8%, which tells you this fund is truly focused on international diversification. They're really spreading their bets across developed markets. Switching gears to the Hartford Midcap HLS Fund, costs were $38 to 0.76%. This fund has $800 million in net assets and 74 holdings, a bit more concentrated than some of the others we've seen. Sector-wise, industrials are the biggest piece at 24.1%. Then information technology at 22.4%. Consumer discretionary follows at 18.6%. This fund is leaning into companies that make and sell physical goods and services and are sensitive to economic cycles. Now, for the Hartford Small Cap Growth HLS Fund, costs were $32 or 0.67%. This fund holds $522 million in net assets and has 149 holdings. We see industrials again leading at 23.5%, with healthcare following closely at 21.4%. Information technology is at 20%. These are all sectors with companies that have a lot of room to grow, which aligns with a small cap growth strategy. Next up, the Hartford Small Company HLS Fund. Costs here were $40 or 0.81%. This fund has 399 million in net assets and 102 holdings. Industrials lead again at 26.0%, with healthcare and information technology right behind, rounding out the top three. This shows a strategic focus on sectors that can deliver growth even when the broader economy slows down. Let's look at the Hartford Stock HLS Fund. Costs were $26 or 0.52%. It's a substantial fund with $1.2 billion in net assets, but only 45 holdings. That's a very concentrated portfolio. Information technology dominates here at 21.53%, followed by financials at 15.8% and industrials at 15.6%. Healthcare and consumer discretionary are also significant. This fund is heavily weighted towards sectors that have shown strong growth potential. Now, for the Hartford Total Return Bond HS Fund. Costs were $26 or 0.51%. This is a large bond fund with 129 assets and a whopping $12.99 in net assets and a whopping $12.99. On the security type breakdown, US government agencies are the largest at 42.5%. This implies a focus on stability and perceived safety. US government securities make up 26.3% and corporate bonds are 23%. This is a very traditional conservative bond portfolio. Finally, the Hartford Ultra Short Bond HLS Fund. Costs were $23 or 0.45%. This fund has $508 million in net assets and 332 holdings. In terms of security type, asset and commercial mortgage-backed securities are the largest chunk at 35.2%. Corporate bonds are 25.6%. And then US government securities at 19.7%. This fund is focused on very short-term and relatively safe investments. Given the ultra-short label, now for my take on these numbers. What I see is a clear trend across many of these funds, a heavy leaning into information technology and financials, especially in the capital appreciation and disciplined equity funds. This suggests confidence in those sectors driving growth. However, it also means these funds could be more vulnerable if those sectors face headwinds. The bond funds, particularly the Total Return Bond HLS Fund and the Ultra Short Bond HLS Fund, are playing it much safer, with a heavy allocation to government and agency-backed securities. This indicates a more risk-averse strategy, which might be a good thing in a volatile market but could limit upside potential. What's interesting is the variety in concentration. Some funds like the Disciplined Equity and Stock HLS funds hold very few securities, suggesting high conviction bets by the management. Others like the Total Return Bond Fund hold a vast number of securities, almost mimicking an index. This difference in strategy could lead to very different performance outcomes. The costs are also worth noting. While most of these are in a reasonable range for actively managed funds, there are some variations. The healthcare and international funds are a bit higher, which is common in those more specialized areas. Investors should always consider these fees as they directly chip away at returns over time. Looking at the overall picture, Hartford seems to be offering a diverse range of strategies catering to different risk appetites, from aggressive growth plays in tech to the stability of government bonds. The key for investors is to understand which strategy aligns with their own financial goals. For me, the big takeaway is the sector allocation in the equity funds, especially the heavy weighting in tech, which could be a great thing if that continues to soar, but a significant risk if it falters in the near term. Alright, that is our deep dive into the Hartford Series Fund's latest financial report. What do you think about their investment choices and the costs associated? Are you invested in any of these funds? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more insights into the corporate world. And don't forget to join our Discord community. Link is in the description below. Thanks for watching, and I'll see you in the next one.